Live from Bloomberg's world headquarters in New York, I'm Isabel Lee.
And I'm Tim Stenevec. Welcome to Bloomberg Crypto. It's a look at the people, transactions, and technology shaping the world of decentralized finance.
Here's what's at stake today. Prediction markets have seen tremendous growth, but they hit a little speed bump with the SEC as regulator delays the launch of a wave of ETFs tied to the markets.
Plus this hour, we're going to be joined by former CFTC Chair Chris Giancarlo. We'll discuss the state of regulation in the U.S. and its recent move over to Jefferies.
Plus, a surprising revelation in SpaceX's recent IPO filing, Bitcoin on its balance sheet.
That's all ahead over the next hour right here on Bloomberg Crypto. First, a check of how things stand. Bitcoin trading lower today as we do see stocks at a record over AI earnings, the possibility of a U.S.-Iran breakthrough. Over the last 7 days, we've seen moves as high as $78,000 per Bitcoin, going all the way down last week to $74,280. Here's the thing. Expected volatility for Bitcoin is actually at its lowest level in 9 months. You can see what happened with this big scare, the volatility over there in February. This lack of volatility is all due to subdued trading, a shift in speculative interest away from Bitcoin. Get this, U.S. spot Bitcoin ETFs have actually seen net outflows of about $1 billion so far in May. That reverses a 2-month stretch of net inflows that added signs that investor demand has cooled, Isabel.
And let's take a look at IBIT. This is BlackRock's Bitcoin ETF, the largest ETF in the cohort, comprising some 60% of the assets. So as you can see, it has seen 6 straight days of outflows, totaling more than $1 billion. So the exodus comes as the broader momentum for Bitcoin has slowed. Remember, in 2024, Bitcoin rode a wave of mainstream legitimacy. Think ETF wrapper, Wall Street endorsements, just really a spot on the financial advisor menu. But this year, it has lost some of those very market. I mean, retail investors have petered out, rotated out, institutional flows have thinned. To be sure, though, overall, Bitcoin ETFs in the U.S. still command roughly $100 billion in assets.
Well, speaking of ETFs, the SEC issued a memo delaying the debut of several prediction market ETFs, a surprising move given how accommodating SEC Chair Paul Atkins has been when it comes to digital innovation. Vildana Heinrich covers digital assets for Bloomberg. James Seyfert covers ETF funds and alternatives for Bloomberg Intelligence. They join us now for more. Vildana, I want to start with you. What's in these ETFs?
So it was only a matter of time, really, before prediction markets were going to be tied into the ETF wrapper, right? Or for somebody to try to figure out a way to tie prediction markets into the ETF wrapper. Everything is ETF-ified these days.
Oh, yeah.
And so what they were going to be is binary bets. For example, will Republicans win XYZ election? Yes or no? And so what you were going to be betting on is, you were taking a side. However, things have just slowed down a bit maybe in that process. A lot of people still think that these ETFs will eventually come to market, but the SEC maybe is fielding some questions for the issuers who are behind the filings for these.
Okay, James Seyfert, come on in here because you understand sort of like, well, everything about ETFs and you know how you securitize this stuff or how you create derivatives from it. If what Vildana is saying, was supposed to happen and doesn't happen, what is the underlying product that actually allows, that is being wrapped up in an ETF that allows people to make that bet?
Yeah, so most of these filings are specifically looking at using swaps. So the underlying asset on those swaps, so they're derivatives, and the underlying asset on those swaps was going to be Kalshi prediction markets. So they were going to use whatever Kalshi was saying to basically generate the swaps that they would, enter into with banks. But like Vildana said, I think there's been some concerns. I think they'd be mostly okay with the things that have been filed thus far. I think the main concern from the SEC at this point is like drawing a line somewhere. They don't necessarily want, 2027 Super Bowl ETF winner ETFs.
James, would you classify prediction market ETFs as perhaps more speculative than leverage ETFs? Maybe 3x or 4x, because we have 2x already.
I put them all in the same category. These are trading products. I mean, there are some ways that you can use this to hedge certain things. That's definitely what people will use them for. I mean, it also kind of takes away the third, fourth derivative nature. So like if you're trying to predict what's going to go on in the Senate or the House and then get third, fourth order effects, like it's really hard to get that. Whereas this is like, I can just bet on what I think is going to happen in this election. And maybe there's some specific thing that I care about. But like if you're trying to gather like what stock is going to do and respond in what way, it's very hard. And people have made livings doing that wrong.
Vildana, I want to go to Bitcoin. Vildana leads, by the way, the crypto
topic.
cross-asset team. So She knows all about everything. Talk to us about the significance of the $83,000 mark. Why is it good news and bad news, it seems?
Yeah, it's something really interesting happening in crypto markets with Bitcoin in particular. So we had a sort of mini stealth rally, I was calling it, a couple of weeks ago, where Bitcoin was slowly inching higher. You know, in the past, we've known it to have these sort of explosive moves up or down. It had been inching slowly higher towards the $80,000 level, and around 80,000, 82,000, 83,000 is where a lot of Bitcoin ETF investors break even. And so the idea is that when the price is getting to around that level, that a lot of investors, those Bitcoin ETF holders, are actually selling out. So all of the little mini rallies are getting sold. So, you know, it's good news and bad news, as you said. Like, you're getting the rally part, but then the comeback again, as we're seeing with the price level currently.
Yeah, James, jump in on this and talk to us about what you're seeing when it comes to price action, especially with the Bitcoin spot ETFs.
Yeah, I mean, no matter how you slice it, anything in crypto, including the crypto ETFs, trade very technically. So you get to these like 200-day, 200-week moving averages. It's very hard to push above them. And once you get above them, there tends to be a lot of momentum, also going to the downside, as we recently saw. But yeah, like Vildana said, we've seen a lot of selling on these things, particularly looking at 13Fs. Granted, the data is from March 31st at this point, but we saw selling across pretty much every single holder in the ETF cohort.
We're going to spend a good portion of the program talking about the price action and talking about prediction markets and Bitcoin. So I do want to just go back and end, James, where we began today, and this has to do with, of course, prediction market or prediction ETFs. If you go back to what you were telling us about the underlying product, why would somebody, what is the market for that, given that it's so easy to make a bet on a prediction market? Like, why do they think there would be demand for a product such as this that's traded as an ETF when many people would argue it's easier to just, you know, download Call Sheet and do it there?
Yeah, I'll take the complete opposite side of this.
Please.
And emphatically. This is an area that we think could be another massive new category. We have these derivative buffer ETFs. We have all these single stock ETFs that people were asking, why do we need them? I can't tell you how many people were telling me that I was way too bullish in the demand for Bitcoin ETFs because anyone who wanted Bitcoin could open a Coinbase or Gemini account and get exposure to it. If you just take these things, part of what ETFs do is they democratize exposure to different things. They just make it really easy. A lot of people have brokerage accounts. It's just going to make it super simple to get exposure, and it opens the door for people like advisors to, you know, possibly put this in a client portfolio. Like I said, these are more trading vehicles, but I think never underestimate the ability of the ETF wrapper. Just be the easy button, really, to make any sort of trade.
Well, Donna, when you talk to sources, what do they make of prediction market ETFs? Because to James's point and to Tim's point, prediction markets is already retail. What's the point of wrapping retail into a retail?
Well, there's a couple of ideas, and a lot of people actually will say exactly what James just said. I know we all love ETFs and we love talking about ETFs, but you know, they are popular for a reason. Like the cheapness, the ease, it's the one-click, you know, characteristic, the inherent characteristic of
accounts, maybe?
Exactly. I think the way it's been described to me is that let's say you are taking a side on one of those bets, like will XYZ win XYZ election way out in the future. You're doing it because you're hoping to gain the upside on that until the November election, instead of doing it like 2 or 3 days before the actual election happens. So it would be a bet on what you think is the right outcome, the wisdom of the crowds, that type of thing. But again, it is the ease of trading, the cheapness of ETFs in general. On the other side, maybe for institutions, it's a way to add something to their portfolios or to hedge certain positions using these ETFs. Again, they have not launched yet. It's been slowed. The process has been slowed down, so we'll see how it actually plays out. But a lot of people are saying exactly what James is saying.
So, James, it raises the question about what Vlad Tenev has said recently of Robinhood, that prediction markets are an asset class. Is that true in your view?
Yeah, I tend to think it will be largely true. Like I said, there's going to have to be a line drawn somewhere with things that have true economic outcome. Obviously, this is probably going to be a Supreme Court battle between these platforms versus, sports betting markets like FanDuel and DraftKings that don't want this to go into their states. The CFTC is on the side of these prediction markets. I don't know how it's going to play out. It might end up needing Congress to get involved. But at the end of the day, I do think, like, particularly even if we just take sports out of it, I think these, election markets and other economic indicator markets, even on stocks, you name it, I think it will be a big category in a new way for people to make trades and hedge things.
James Seyfert of Bloomberg Intelligence, also Bloomberg News' Vildana Hyrick joining us here on set. A big thank you to both of you. Coming up in just a minute, Katrina Paglia of Pantera Capital is joining us to talk about how the Clarity Act could create a new market for, quote, yield as a service. Don't forget, you can access all the latest data, news on crypto. Just check out CRYP Go on the terminal. This is Bloomberg.
Now to the political exchange in Washington. The Clarity Act could finally define digital assets into U.S. law and establish clear regulatory jurisdiction for crypto. It could also create a new market, yield as a service, through use of the tokens. Let's discuss with Pantera Capital Chief Legal Officer Katrina Paglia. Thank you for joining us on this Tuesday in studio. I hope you had a great weekend. Maybe we could start with that. Do you think that the Clarity and the Genius Act will be signed into law, and will we see that soon?
Yeah, so we saw Genius come into or get signed last year. So that's been a really good thing for the stablecoin industry. We've seen more consumer protection with the yield backing and the dollar-to-dollar requirements with the Genius Act. Clarity had a huge week 2 weeks ago, right? So we had the Senate Banking Committee pass it on a bipartisan basis, which is great. So now it goes to the Senate Agriculture Committee to combine the two versions of the bill. And this is one of the biggest moves we've seen for legislation in the U.S. for digital assets to date. So we're all super excited about it. And the momentum is building. If you look at the Polymarket and the Kaiki odds, we're over 50% likely that this is going to pass, which is huge. And the sentiment from a timing perspective is there's a push to get it done before the interims. There's momentum. And if you take a step back and you think about everything that's going on right now in the world, the fact that the administration and DC is this focused on our asset space, our legislation, is huge. It means that it's very important. Again, it's bipartisan, which we haven't seen before. We had 2 Democrats vote for Clarity to move forward, and we're all just very optimistic about it.
Well, maybe they saw what happened in the midterm, or not in the midterms, the 2024 election, and the way that the crypto industry lobbied behind certain candidates and spent many, many, many millions of dollars. It
was the largest single issue PAC donations that we had seen. It 100% drove the election results. Like, there's no question about it. So digital assets are here to stay. Blockchain is here to stay. And I think we're starting to see support on both sides of the aisle.
Is that a good thing, though? And the reason, big picture, I ask is because it's like we hear about money in politics, and this is like, this is sort of getting out of our lane here a little bit. But if it was the single biggest issue, you look at the issues that are, at least in terms of money, you look at the issues that voters care about, and it's like, it's affordability. And it's a hard line to draw that puts this and makes gas cheaper.
Yeah, 100%. And, there's a lot of controversy around it. One of the biggest issues that what you saw on the Senate floor when they were voting on Clarity 2 weeks ago was ethics. It was, KYC and AML, are investors protected? Is DeFi really the right answer? So there's definitely some controversy around it. And to your point, Tim, I agree. Economics, affordability, the price of milk, super important. There was just a groundswell for the voting base in terms of crypto. And that just shows the generational shift that I think is happening right now.
I want to ask about digital asset treasuries, because one could argue that Pantera is one of the most involved VCs in this space.
Yes.
What do you make of them? Is there room beyond the strategies for Bitcoin and Bitmine for Ether for the smaller guys or up-and-coming ones?
So the digital asset treasury, or the DAT trend, was very popular. We co-sponsored one. We invested in several of them. I do think kind of where we're at now, the trend has calmed down. And I think people are maybe starting to see the value prop outside of the really bigger ones is just not necessarily there. So my sense is if you got in at the right time, which I do feel like Pantera did, great. But I don't necessarily see this as a continuing trend because you can have access to these digital currencies directly.
So then what is the opportunity right now from a venture capital perspective? If a little bit of the shine has come off of digital asset treasuries, where's the excitement?
Tokenization. Yeah. It's huge. Tokenization of real world assets. We're starting to see Ondo is one of my favorite examples. U.S. Treasuries going on the blockchain is huge. I think you're going to start seeing real-world asset tokenization of, mortgages.
Is it about more than just 24/7 trading? What is that about? Is it securitizing everything?
I think it's securitizing everything.
Okay.
Well, 24/7 trading is really interesting to Pantera because as an RIA, now you have to ask yourself a question of, we're outside of the stock market 9 to window, right?
I know. I'm getting notes over the weekend about people looking at hyperliquid and the way oil is trading on hyperliquid.
So now we have a fiduciary duty to our investors to really think about, should we be trading 24/7? It's kind of shifted the way that RIAs should think about things when you're in the digital asset space. So I think it's really interesting.
Is there an asset class that, in your opinion, shouldn't be tokenized? And I guess on the other end of the spectrum is the most tokenizable? I guess equities probably.
I think
money market funds?
Equities, money market funds. I think those are really interesting. They're the first ones that are going to come on chain. In terms of what shouldn't be tokenized, I have a hard time coming up with an example because you have this transparency, you have this 24/7 accessibility, and I'm sure there are smarter people than me that will come up with an example. But to me, the benefits of it just outweigh any negative that I can kind of think about in terms of why you wouldn't want it.
I want to go back to your optimism over what's happening in Washington, specifically clarity. Why aren't we seeing the optimism play out in Bitcoin as an asset right now?
I think because we're seeing literally clarity. I think the traditional finance players who are maybe sitting on the sidelines right now are finally starting to see the progress in DC where they're going to be able to get comfortable in this asset class. And so there's a lot of capital sitting there waiting for it.
I also want to ask about prediction markets because you also have insights in that. At what point do they become destabilizing? At what point does the con outweigh the pro?
Prediction markets are fascinating and a very new thing. We just did one of our largest investments into Novig. I think they're super interesting, but also very controversial from a compliance perspective. When I put on my CCO hat, I think about insider trading and, the great example of Brian Armstrong saw some bet on one of them of is he going to say Bitcoin at the end of the earnings call? Yeah. And you're if you knew what his speech was, you could have really placed a bet. Or what's Bad Bunny's first song at the Super Bowl going to be? Anyone who's in that grass that was on the field, how do you police that? So I think it's interesting. I think there's going to be fewer players than more at the end of the day. But I do think from a legal and compliance perspective, we really have to think hard about this.
I think a lot of people would agree with that. Always good to check in with you. Katrina Paglia, she's Pantera Capital Chief Legal Officer, joining us on set. Well, coming up, the SEC was planning to give broad exemptions for U.S. crypto firms to trade tokenized assets tied to stocks. Now, those plans have been put on hold. We're going to get into why some exchanges and market participants are against tokenization. That's next on Bloomberg.
Nora Melinda. Let's take a look at your midday movers. First up, the S&P 500 is rising with hopes for a peace deal between the U.S. and Iran, overshadowing military strikes in the Persian Gulf. Tech and industrials are leading the gains. Still, that uncertainty in the Middle East is lingering in the oil markets. Brent crude hovering around $100 a barrel. Brent had slumped more than 7% on Monday. In company stories, Ferrari shares are falling after critics reacting negatively to the design of its first fully electric vehicle. The stock is on pace for its worst day since October. And American Airlines shares are surging. The airline plans to install SpaceX's Starlink satellite internet service across more than 500 narrow-body aircraft beginning in early 2027. Those are your midday movers. I'm Nora Melinda.
Time for Token Moment, where we look at the efforts to tokenize different parts of the market. The SEC delaying a plan to provide exemptions for U.S. crypto firms to trade tokenized assets linked to stocks. People familiar with the matter tell Bloomberg that the SEC was preparing to release its new rules last week before deciding to delay. According to Bloomberg Intelligence, proponents say tokenization makes securities portable, facilitates real-time settlement, and enables automatic via smart contracts. The new approach, though, being considered by the SEC, getting some pushback from exchange officials and market participants. Scott Patterson has been covering this story for Bloomberg News. He joins us now. Scott, you were on with us just last week and talking about the latest with this. Since then, there have been some developments. What's the pushback here?
Yeah, I think that the pushback is largely questions that market participants have, industry participants, traders, exchanges, since the reporting on this has come from Bloomberg, and the SEC hasn't said anything publicly about it. So what we hear is the phone's ringing off the hook at the SEC from all corners of Wall Street, and they're asking questions. There is probably some pushback, but I think right now it's more news gathering from industry, trying to figure out what the SEC is planning. And there also were some aspects of what we reported that the SEC was doing that took a lot of the industry by surprise.
This is a great scoop that you had, and you followed through with a news story on Friday. And you said not all SEC officials would support a decision to allow third-party token trading. Why would someone support it, and why would someone not support it?
I guess it depends on where you stand. I'm told that the Hester Peirce, Republican commissioner of the SEC, has been driving this effort to tokenize third-party securities, which are not issuer-backed. That is seen by some market participants as a bit extreme, and even some inside the SEC feel like that might be taking things a bit too far, especially in this initial wave of tokenization of securities. There's some that feel like if this move to what is essentially, could be a massive change to how individuals invest in the United States, it doesn't have the explicit backing of issuers, there could be a bit of a credibility problem with the effort. So there was this initial desire to just go with issuer-backed tokens, but that changed in recent months as Peirce pushed through her vision, which is in some ways backed by an ideology of libertarianism and this idea that you should just let the market work out for itself the kinks and have a little more deregulatory approach to the market.
Just 30 seconds here, Scott, but my favorite quote in your story is, "Nobody is asking for this." What have the sentiments been like in your reporting?
Yeah, that comes from a broker-dealer who talks to investors. That's Joe Saluzzi at Themis, and he's dealing with just regular investors and fund clients who directly addressing the issue of 24/7 trading in that quote. I think there are a lot of people out there, traders and fund managers, who aren't really relishing this idea of having to get up on Sunday morning.
We love having a couple days off. Scott Patterson with Bloomberg in Washington. Much more Bloomberg Crypto next.
Welcome back to Bloomberg Crypto. I'm Isabel Lee alongside Tim Stanovic. Former CFTC Chair Chris Giancarlo was an early adopter of digital assets at the agency. Now he's joining Jefferies as senior advisor focused on investment banking. Chris Giancarlo joins us now live here on the set. I believe it's your first time in Bloomberg Crypto. Thank you for joining us.
As they say in talk radio, first time, long time. So I'm delighted to be with you.
Yeah, and congratulations on the appointment, the new post. Maybe that could be your first question. What will be your biggest agenda at Jefferies? I feel like you touch on many things from crypto to digital assets, but what's top of mind?
You know, I've been through almost 3 phases of crypto since my time at the CFTC, when really policy environment was indifferent to crypto. The divide was really generational. It wasn't political. And then gradually during the Biden years, one side became hostile and just the overall approach was a headwind to innovation. And during that time, I spent with Wilkie Farr & Gallagher, a law firm, mostly helping builders avoid some of the hostility coming out of Washington. Now the policy winds have changed. It's really a tailwind for builders. And so I've joined Jefferies really to be part of assisting firms in raising capital and building. You know, before I went into government, I built my own company, took it public onto the New York Stock Exchange, GFI Group. We were the first to apply to electronic trading to interdealer brokerage. So it feels to be good back in a building stage again, helping builders and innovators.
Where do prediction markets come into this, given your role at Polymarket and sort of how you're thinking about this space?
Yeah, so I have no official role at Polymarket. I did serve as an advisor in the first few years of the company. I have none today, but I'm still very bullish on prediction markets. I think along with stable coins, prediction markets are some of the first innovation coming out of digital networks of value. I expect there will be more innovation to come, but these are some of the first two tangible, really global innovations.
Do you think that this is an actual new asset class? We had this conversation with James Seyfert over at Bloomberg Intelligence earlier. Vlad Tenev over at Robinhood calls prediction markets an asset class. Do you agree?
Well, what I would say, it's a new form of derivatives. Okay, and we haven't yet seen its full flowering into corporate use. But that's really the opportunity. You know, one of the big challenges in corporate America is to get perfect hedges on your risk. And a lot of derivatives offer hedging opportunity, but not really a perfect hedge from an accounting point of view. Once corporates can actually get a perfect hedge using these markets, the use of them is going to be phenomenal. So I think they are really a tremendous new innovation, although I would say they're a new derivative, not necessarily an entirely new asset.
But very early days still?
Still very early days in this innovation. The builders in this innovation are young people in their 20s and 30s. We haven't really seen the industrialization of this asset class in the same way we've seen the industrialization of stablecoins, but we will, and I don't think it's that far off.
So why do you think prediction markets like Kalshi and Polymarket should be treated as financial risk markets rather than sport books or casinos, which they're always connected with?
Great question. In a sports book, it's a casino operation. So the house sets the odds, and every participant can be a price taker, but they can't be a price maker. Okay? In a prediction market, it's truly a marketplace. All the house does is set the proposition, but it doesn't win when others lose. Participants are price makers and price takers. So it's very much a marketplace, as opposed to a casino, which is effectively a retail establishment. Here are our prices. You can take these prices, but you can't make these prices. It's not a marketplace. Retail establishments are traditionally regulated at the state level. Marketplaces are traditionally regulated at the federal level. Imagine having one state or 26 different states trying to regulate global markets. That's not the way we've rolled in the United States. We've assigned marketplaces to the federal government.
So then should DraftKings and FanDuel be regulated by the CFTC and not by states?
No, because they are sports books. But
they also offer prediction markets.
Their core business is really in wagering against the house. That's their core business model. And that business. Now, if they go into true markets, then we need a federal regulator. If it's wagering against the house, then it's a state regulator.
So could they thread this needle by splitting off a portion of that business?
Sure.
And
so we don't choose regulation by who the company is. We choose regulation by what's the activity. Mm-hmm. If it's truly a marketplace, two sides.
Okay, so sorry, just to push back a little bit on this, forgive me, because this is the sports betting part of this is such a big part when it comes to prediction markets. I mean, Bloomberg Intelligence estimates it could be between 80 and 90% of what happens on some of these prediction markets.
Jefferies also has some estimates of the size of this.
So sports is so huge. So it's just hard, I think, for some people to hear, well, if I can do this, if I can bet on the outcome of the Knicks game on DraftKings or FanDuel, and also bet on it on Polymarket or Kalshi, why is there a difference? So
we haven't traditionally divided marketplaces by the activity. We divide, it's sort of like trying to cut a 7-layer cake by the layer.
Yeah.
Sports, the way we generally cut it is it a marketplace? A marketplace where the house just sets the proposition, doesn't make money on who wins or loses. That's regulated at the federal level. It should be regulated at the international level, but we don't have an international state to do it. So we regulate at the national level because it's, by definition, crosses borders. But casino operations, where the house sets the odds, everybody can take the price, but that's all they can do, is generally regulated at the state level. What we're talking about here is pretty consistent with the way we've been doing this for a long time. Dividing it between sports and non-sports is really not the issue. The issue whether it's a true marketplace.
Another concern that's always brought up with prediction markets is how do you prevent politically connected actors, or bad actors, or just actors, to stop profiteering from non-public information? I feel like that's one of the biggest sticking points right now.
Absolutely, and there's already a law on the books. The CFTC already has its version of insider trading bans, and we're already seeing both the platforms themselves, in the case of Kalshi and others, prosecuting people for violating that ban, but also the CFTC doing that itself. So that ban is, now, do we need to maybe enhance that ban? Do we need to add some? That should be decided. The CFTC is in the process of rulemaking now. Whenever you have a new technology, and I faced this when I greenlighted Bitcoin futures 10 years ago, there's a lot of hue and cry. There's a lot of people saying, wow, this new technology allows all these things. That's why there's a rulemaking process. I believe the right response to new technology is not to put our head in the sand and say, let's pretend it goes away, The right response is to get the regulations right. And if we need to fine-tune regulations written a decade ago for this new innovation, we should do it. And I commend Chairman Seelig for starting a rule-making process and inviting public comment.
Does the CFTC have the person power to do this right now? I mean, you're in such an interesting position because of your experience in the private sector as a builder, as a founder, but also your experience as a regulator at the CFTC as well. Does the CFTC need more resources?
It's always needed more resources. It needed more resources when I was there 10 years ago. It needs more resources today.
How much more resources?
Congress has to give it those resources. It's giving the agency more responsibility. It needs to give it more resources.
If you could wave a magic wand and tell Congress this is how much money we think it needs
I want to be careful
effective.
here, Tim, because I'm not in the seat. When you're in that seat, you have a sense. I don't really know what the person power is there right now, but I would estimate it needs anywhere between 10 to 20% more resources, and I'm guesstimating.
That's not as much as I thought you'd say.
Yeah.
Okay.
Maybe for one.
That seems doable.
Yeah,
I'm not in
totally
Washington.
doable.
That doesn't seem crazy.
Compare that to, one of the things we're talking about is, do the states do this to the federal government? If the CFTC needs more resources, what do you think the states have to police global markets?
When you look at crypto, what else do you think it needs to, what's the next catalyst? Because when you look at it, it's so institutionalized. I mean, you see Bitcoin ETFs, you see hedge funds trading it. It's everywhere in Wall Street.
Isabella, we're really in an interesting phase right now. It's another reason I went to Jefferies, because what we're seeing right now is the industrialization of this. This was buying and selling tokens for a while was in the promise that would come, in the same way that people bought Tesla 10 years ago in the hope that the future of transportation was electric, right? Now it's here, and everybody's building electric. The same thing is here, is the promise of crypto was that the institutions of Wall Street would adopt it as its fundamental architecture. That's now happening. Look what DTCC is doing, Depository Trust Clearing Corporation, putting their entire warehouse onto digital rails. Look what all the major banks are doing. Look what the Bank of New York is doing. The time has now come that industry is building this as the architecture. The architecture of finance in the future is going to be built on digital networks. And that's going to be transformative for people that use the financial system to build companies, to finance their college education, et cetera.
Talk to us again why supporting crypto and CBDCs should coexist and why one isn't necessarily competing with the other. I feel like that's an argument a lot I see on X or Twitter.
I'm so glad you asked that question. They're fundamentally different. A stable coin is a corporate liability. In no different than a bank deposit is a corporate liability. It's a liability of a bank, or it's liability of a stablecoin company. It's not a sovereign liability. When things go bad in the banking system, what do people do? They go to the ATM machine. They go to the ATM machine to take possession of their money, yes, but to really convert the obligation from a bank obligation to Uncle Sam's obligation. They want to know their money is directly backed by Uncle Sam. That's why you take cash out. In a similar way, if there's a run on stablecoins, and I'm not predicting one, but there have been in the past, people will want to go to a sovereign obligation. And that's the fundamental idea of a central bank digital currency. It's a sovereign obligation. Now, we have seen central bank digital currencies put out by China that are meant to be control instruments to control society. That's absolutely not what we want in the United States. We're seeing Europe going forward with a digital euro that, while it's not a control instrument, it's a surveillance instrument. Again, that's not what we want in the United States. So certainly the idea of a central bank digital currency can be scary to some if it's designed wrong. But there's no reason why it couldn't be designed right, reflecting the values of a free society. I don't think we're ready for that right now. And I do think the United States experimenting with the private sector to modernize the dollar is the right way to go. Our private sector is so innovative. It's going to develop not only the stablecoins, but the apps and the different technologies built on top of it that are going to make it really powerful. Wait till your iPhone 20 comes with a digital wallet, and in it are all kinds of ways to manage your money with calculators and AI. That's just one or two versions away. That's coming. People are going to get really used to. Here's the analogy for digital money, whether it's stable coins or CBDC, digital photography. In the world of film photography, those old film photos sat in a dusty photo album. You never look at them. But every photo you've taken with your iPhone lives forever. You do things with it. You post it online. Well, wait till your money is as facile as your digital photographs. That's the promise of stable coins and digital money.
Giancarlo, good to see you. Thank you so much for joining us. We could go on for hours. Do appreciate you taking the time. He is a former CFTC Commission chairman. Chris Giancarlo, now over at Jefferies. Coming up next, 9 anonymous cryptocurrency wallets have gained control over Polymarket's most contested prediction markets bets. That and more on Prediction Markets with Ambre Soubiran, CEO of the crypto data and analytics platform, Kaiko. This is Bloomberg.
Day in New York, I'm Nora Melinda. Let's take a look at your midday movers. First up, the S&P 500 is pairing early session gains as investors weigh slipping U.S. consumer confidence against hopes for a peace deal between the U.S. and Iran. Tech and industrials are leading the gains. Still, that uncertainty in the Middle East is lingering in oil markets. Brent crude hovering around $100 a barrel. Brent had slumped more than 7% on Monday. Speaking of oil, BP shares are falling after the company fired Chair Albert Manifold just months into the job over concerns about governance standards, oversight, and conduct. The stock is having its worst day in more than a month. And finally, AutoZone shares are tumbling after the company posted comparable sales for the third quarter that fell short of Wall Street's estimates. The stock now sitting at its lowest level since November 2024. Those are your midday movers. I'm Nora Melinda.
Let's get to the odds. An in-depth look at the booming growth of prediction markets. A group of just 9 crypto wallets are dominating Polymarket's disputes and resolution mechanism. It's the way that winners and losers are determined on key issues like war and elections. You can see the notional trading volume of disputed contracts on Polymarket jumped from March to April. An analysis by Bloomberg News found these 9 wallets decided the outcome of more than $1 billion in contracts in April alone. Bloomberg data editor Andre Tartar has been covering the story, and he joins us now. When the outcome of a question is disputed on Polymarket, how does it get resolved?
So it's actually on a separate blockchain entirely. So it's holders of a cryptocurrency called UMA who really get to have that vote and decide the resolution of the Polymarket issues, yeah.
So why does this matter and who's complaining? This was, by the way, a fantastic data reporting project that you guys did.
Thank you. So our team crunched the numbers on a couple of thousand markets recently, which have disputed in the past few years. And really, as Polymarket's volume surges overall, as have all these disputes, there's been about $5 billion of trading on these markets in the past few years. So really, it's becoming like a really real part of the issue here for them.
So what is Polymarket doing about this?
They've claimed that they want to reform this process because it is getting a lot of complaints from both Polymarket users and these holders of the UMA tokens because of this concentration of the whales. Just 9 wallets, as we found, control about half of all the votes. So Polymarket has been working with both the org that runs this UMA token to reform it, but the reporting for the story found that it's actually been pretty much put on pause as Polymarket focuses on its expansion.
Well, as Isabel said, it's a great piece. Everybody should check it out on Bloomberg.com and on the Bloomberg terminal. Big thank you to Bloomberg's Andre Tartar. Well, let's keep the prediction markets conversation going with Ambre Soubiran. She's the CEO of Kaiko. It's a leading independent provider of cryptocurrency market data and analytics. When you hear about that from Andre and from the Bloomberg News team and how something is disputed when it comes to the data, what are you seeing on Kaiko's platform to sort of, refute it or at least support what people are saying?
So I think that, I love what we're approaching this whole prediction market with a data angle. It completely highlights the importance of data. And data, meaning like those are events-driven contracts, right? They're short-dated, they resolve very fast, and capital is recycled fast. And so you need to be able to settle those contracts and kind of move on and recycle capital. So the reference rate, specifically when we talk about price contracts, is the price of Bitcoin going to be up or down at a specific date? All of that needs regulated reference rates. The fact that Kalshi is one of the biggest prediction markets now by volume and is a CFTC-regulated market is extremely important when you think about the data aspect. So there's 2 angles here. One of them is the data that is used for contract resolution, and the other one is all of the data that you can gather from the activity of those exchanges, right? We've seen prediction markets go from like an experiment 2 years ago to something that has scaled immensely, and like volume has grown 10x to trading $25, $30 billion monthly today. So data is critical, both on the resolution side and also on the monitoring the activity side.
On that point, volume has grown 10x since 2024, but open interest has kept pace. What does that tell you? Do you think that these markets are becoming more short-term trading venues than having trading with conviction, probably?
So these platforms are event-driven contracts, right? They are short-term in nature, and so capital is basically recycled really fast. So we see volume, as in turnover, has grown significantly, but it's very often the same capital that is just, the contracts expire and is recycled in reinvestment into the venue. So this is obviously more specific to prediction markets. You don't have that on spot exchange trading when you buy and hold. It is the nature of prediction markets that recycle capital with high velocity.
Ambre, does it change when it becomes more mainstream?
No. I think retail will have probably a very similar approach to reinvesting their capital as soon as the contracts are resolved. I think this is structural to prediction market, but is the way it's going to keep going.
How much of the activity is driven by hype cycles and narratives like SpaceX going public or just like anything?
Yeah, so we've clearly seen, two big trends, whether it's the prediction markets that is a very event-driven type of activity and trading activity. So clearly there is hype around specific events. We see that also with platforms like perpetual swap markets, right? Where whenever you have an event, there is more hedging and trading activity related to that. So it is still very much event-driven, but we're seeing a large number of contracts that are just kind of, continuously renewed contracts and not necessarily event-driven.
Ambre Soubiran, CEO of Kaiko, joining us here on set. Well, coming up next, an SEC filing reveals that Elon Musk's SpaceX hold more than double the number of Bitcoin than previously disclosed. That's next on Bloomberg.
According to an SEC filing on Wednesday, Elon Musk's SpaceX holds more than twice as much Bitcoin as previously estimated. Here to break it all down with us is Bloomberg's Ed Ludlow, co-host of Bloomberg Technology. Ed, Elon Musk's view on Bitcoin have swung between endorsement to skepticism. Where does it stand right now?
Yeah, there's a big difference in the SpaceX story between the what and why of these Bitcoin holdings. So as of that regulatory filing, they hold 18,712 Bitcoin, and the average purchase price over the history of the holdings is like $35,000 per token. So Bitcoin costs them about $661 million to acquire. The value of the holdings is $1.3 billion. And like the way that SpaceX would tell it is, what are they treating this as? Basically, it's held as a treasury reserve asset, just in the way that cash or bonds would be, but by a custodian third party. That's very different to saying, like, well, what is Elon Musk's attitude to it? You don't get that from the filing itself, although I guess if you guys want to have some fun, this is Bloomberg Crypto. Yeah. We could come up with some ideas.
Well, I guess the question is, what does it end up using that Bitcoin for? Does it just sit there as cash and maybe it accumulates or maybe it falls in value, or does SpaceX sell it?
Because what we do know from the filing is that they haven't been sellers since, I think, the end of 2024. The idea, probably, based on the language in the filing, is that Musk might view, or in aggregate, not just Musk, right? There are other people running SpaceX ahead of the world's biggest IPO. They might just see it as a hedge against inflation, long-term asset, but most likely this sort of strategic reserve for its excess cash. Bearing in mind that excess cash is probably doing a little bit too much legwork in the sentence I just said.
Hey, go ahead, Isabel.
Maybe 15 seconds here, Ed. I mean, Tesla accepted Bitcoin payments before and reversed course. Do you think the same will happen with SpaceX?
It's never really taken off. And, I think that SpaceX, right, remember, this is an S1 where everything has to be completely buttoned up in disclosures, be they boilerplate or very real warnings to investors ahead of the IPO. And this is a very sophisticated finance or treasury org at SpaceX. So that's reserve cash or reserve asset seems to be the logic outlined by the doc.
Ed Ludlow, always good to check in with you, even on, and especially I should say, on Bloomberg Crypto. A big thank you, Ed, joining us from San Francisco. Check out Bloomberg Tech. It's at 11 a.m. Wall Street time on Bloomberg TV. And a big thank you to Isabel Lee for jumping in for Scarlet Fu as well.
It's always fun, especially in Bloomberg Crypto and alongside Tim Stanovic.
We have a good time here. Check out CRYP Go on the Bloomberg terminal. Bitcoin right now down about $800 to 76,400. That is going to do it for Bloomberg Crypto. See you same time, same place next week.